Monday the 3rd sees inflation data coming out of the Eurozone. That comes hot off the heel of regional figures coming out on Thursday and Friday. So let's look into those regional numbers, look at what that could mean for the Eurozone inflation figure, and also look for the outlook for inflation going forward and the impact that it could have on easing at the ECB. So first and foremost, let's jump into the recent numbers and what we're expecting for the headline numbers on Monday. So we've seen Spanish inflation coming out, or the monthly figure of 0.4. The expectation was 0.3, so a little bit hotter. But by and large, the positive came from that core inflation rate down to 2.1 from 2.4. So essentially at target. French inflation down to 0.8. Below that 1% mark now. We saw a 0% month-on-month metric against an expectation of 0.6. So big undershoot there in terms of French inflation, well below target. Italian inflation also below target, but at 1.7, an expectation that we would see exactly that. The monthly metric of 0.2 highlights the fact that, they don't have a problem with inflation in Italy. And when it comes to Germany, which is the most important of the lot, it carries the heaviest weighting. It's a 2.3. There had been an expectation it would tick down to 2.2, but we saw that 0.4 monthly figure a little bit higher than expected. And so essentially it's managed to remain at 2.3. So by and large, you're looking at Eurozone inflation is pretty much at target. We've seen some come in a little bit hotter. Some of them have come particularly cooler, certainly with that French monthly figure of 0% versus expectations of 0.6. And so this takes us into Monday, where we've got an expectation that we see a decline in headline inflation down to 2.4% from 2.5. We've got an expectation that we decline on the core 2.5 from 2.7. And so this really points towards the ECB pretty much being able to continue to push and push and push. In terms of headline inflation, you can see here 2.5. Let's look at the breakdown, though. So the last 6 months, if you annualize that out, that's at 0.3%. And if you look at the figures in the middle of this on the left, the hefty numbers that we're waiting to see drop out for these so-called base effects to come into play are from February, which is the one that we're waiting for on Monday, March and April. So do we see really significant disinflation coming into play? If we do, then as you see with that 6-month annualized at the bottom, we're on a trajectory that could take us well below that 2% target if you look at how things have played out over the course of the last 6 months and a bit, quite frankly, is more like the last 9 months. So Eurozone headline inflation certainly on track to get back down to target and some. Then you look at the core inflation metrics, and it's very similar, right? You've got February has 0.7, March 1.1, April 0.7. This is from last year. So when they are stripped out, that's when you see disinflation really kicking in. The 6-month annualized minus 0.87, negative. Last 3 months, minus 4.21. But bear in mind that that is really heavily weighted towards that January figure of minus 1%. And if you look at the January from the prior year, minus 0.9. So sort of negative figures in a January appear to be a seasonal factor. Of course, you've got the sort of December period where everyone's buying presents for Christmas. You come back into January, many retailers do drop their prices to try and encourage people to buy things, but then things sort of pick up after that. So I think you're more likely to see a rebound in terms of February prices compared to March and April. So, do we see a sort of minimal disinflation this time around and then it sort of really gathers pace next month? That's potentially the case. It's worthwhile noting that these different countries carry different weightings. At the last time that I checked, we had the heaviest weighting with Germany, that's 28%, France 20%, the likes of Italy 16%, Spain 11%. That's worthwhile noting. Of course, when if you have other countries, you don't have like regional data coming out of the UK, and then you see the headline UK figure later on down the line. You don't see states in the US, and then you see the US as a whole later down the line. But on this occasion, you sort of see some insight into where things might sort of shape up when it comes to those Monday numbers. And of course, that gives you an idea of the potential implications. So we're looking for disinflation to come into play for the Eurozone over the coming months. This is going to be one of those months. We're expecting to see headline and core inflation decline and more of the same in the coming months, taking us well below that 2% target. What does that do in terms of Treasury yields? Well, ultimately, it brings expectations of a greater degree of easing from the ECB. And you've also got on top of that fears around tariffs in the Eurozone, in the EU. Keir Starmer's gone over there and apparently the US don't want to hit the UK. Well, it's something that I've covered in the past. And certainly there's a reason for that. It's not just because he wants to be nice. It's because Donald Trump knows that the US actually holds a surplus when it comes to trading goods with the UK. So that's not the case when it comes to the Eurozone. Nonetheless, here's the relationship between the ratio between German and UK yields in comparison to euro sterling. Essentially, if we see declines in terms of yields, which would be likely if we saw weak inflation data coming into play, then that points towards further downside for euro sterling. Let's just quickly go on to the outlook for rates as it stands. 100% chance of a rate cut coming into play at the beginning of next month. And we've even got a 7% chance attributed to it for a 50 basis point cut. Then you look further on and you can see, okay, let's see by the end of the year, where do we stand? We stand between 3 rate cuts and 4 rate cuts. So it's the shifting of expectations on the back end of this sort of table that are more likely rather than the near end, because markets are expecting a rate cut irrespective this time around. But certainly if we continue to see sharp declines in terms of inflation and weakness in terms of the economy and potentially tariffs coming from the US, it all points towards a possibility of further additional rate cuts. Now, of course, this inflation data might come in hotter than expected, and in which case you would likely see the opposite, right? People pricing in less rate cuts, the possibility of higher relative yields in the Eurozone and the possibility of a higher euro sterling. But certainly when we're looking at euro sterling, this is the DAX. Let's just quickly bring up euro sterling. So here's euro sterling from a wider perspective. You know, we talked about this in the past and the possibility of this decline coming into play here. That's exactly how it has played out. So this has been absolutely perfect here, really. And we're just seeing a continuation of that. The weekly time frame highlights that by and large, we are seeing declines coming into play. You do see these consolidation phases, and then you ultimately often just see that breakdown through sort of trendline support, and then you carry on that way. So at the moment, we're hesitating a little bit. I wouldn't be surprised to see this hesitation forming a short-term retracement phase, which is exactly what we're seeing here before the bears come back into play. If we see the likes of, let's get the horizontal one. If we see the likes of 827 taken out, then maybe we could come into a wider retracement. But for the time being, I think this currency pair certainly appears to be at risk of further downside to come. And then let's look at the DAX. Now, the DAX is a really interesting one because Germany stands to suffer the worst when it comes to the actions of Donald Trump. If he was to enact significant tariffs on exports from the Eurozone to the US, by and large, it's likely to hit things like cars. And of course, you're looking at an economy that is heavily reliant on the automotive sector. Nonetheless, they also stand to gain potentially the most from a deal between Russia and Ukraine, and that's why it's held up relatively well despite all this Trump tariff talk. And also, it's something that it's kind of been on the cards for a while now, right? So the DAX has performed well at the moment. It's pulled back into the 76.4 fib. If we break the 22117 level, that's when it starts to look a little bit more toppy. But certainly for the near term, we've got a very clear uptrend playing out here for the DAX. And yes, we've pulled back here. We've rallied into a lower high, but we'd need to break through that low to then look like we're sort of topping out from near term and seeing a wider retracement coming into play. Until then, short term, things still look relatively positive here. Let's see how this 76.4 fib holds up. But certainly if we move into a phase where we're seeing more and more rate cuts and ease and very weak inflation data, I think there could be a question mark about, certainly like we've seen over in China, right? When you see 0% inflation out of China, people aren't saying, wow, this is great for the Chinese economy. Instead, they're saying, oh, wow, look how weak the economy is. I think there is a potential position a few months down the line that if we're talking about a possibility of Eurozone inflation going to sub 1%, things like that, that's the point where people start thinking, hold up, these rate cuts aren't actually helping to stimulate the economy. And the inflation picture points towards very weak consumption in the region, and maybe people react to that. At the moment, I think there's a good chance that we still see relative optimism coming into play. But like I said, there's a lot that's coming into it, whether it's the Russia-Ukraine thing, the tariff thing, and then when it comes to rates, of course, you're likely to see more rate cuts from the ECB. But if you're going to see the sort of relative change in terms of yields, you're probably better reflecting that for the likes of euro sterling, or essentially in the FX market rather than in the indices space. That's it for today. Hope it's been useful. Make sure to like, subscribe, and follow for more content like this. My name is Josh Mahony, Chief Market Analyst at Scope Markets.